Okay, very good morning to everyone. Monday the 4th of September. Hope you all had a good weekend. And so let's just get straight into the crux of the matter, which is North Korea. Obviously test firing another nuclear device at the weekend, this being the 6th nuclear test that they've done. And the worrying thing here is that it's starting to show a technological breakthrough where these tests seemingly are just getting larger and larger. And looking at the charts this morning, this is obviously reflecting this renewed escalation, if you like. Last week, if you remember, cast your minds back to, I think it was Friday night, coming into what would have been Tuesday, early hours of the morning for us. You had that ballistic missile test which flew geographically over the northern Japanese island of Hokkaido, whereas now what you've got is a nuclear test that's being done. So a couple of things to look at this, and we'll talk through. This will probably dictate the majority of the briefing itself. But as you can see, stock futures, both sides of the pond, have gapped lower. I wouldn't say this is the most aggressive gap lower I've ever seen by any stretch of the imagination, but the risk-off tone is clearly evident from the overnight Asia Pac session, because gold here, you can see on the top right, we're up around $13. And we've hit highs of 13.45 and a half. T-notes you can see have gapped up and up around 7.5 ticks this morning. So that with yen's strength being a classic flight to quality bid across the different assets. So a couple of graphics to look at then to put this into a bit of context. And one is then, where did this particular test take place? And one thing that you need to realize is that there are actually nuclear test facilities and sites, of which North Korea and the kind of north, where it's very mountainous range, and that's when they tend to, or location wise, where they tend to do various missile type testing. It was said to have been at the epicenter a 6.3 magnitude earthquake on the back of the test that was done, and this kind of validates then by outside sources, namely that in South Korea, that this was indeed, or in fact, a nuclear level test, given the fact that it would be, if this was a regular earthquake by natural means, you would say that this is kind of a fairly decent size as a matching factor. How big have these tests been? Well, I think you really need to look back to the last, 11 years, I guess this is looking back to 2006. And we're looking at the kilotons estimated yield here of the test power. So you can see how on a gradual scale, the tests are just getting larger and larger. I did actually see a stat this morning. See, I wrote it down, I think. Hiroshima was about 15 kilotons is what I've read this morning on Bloomberg here. They've got 13. Apparently the test at the weekend was 50 kilotons. So you think 13, Hiroshima, was large. You know, we're talking multiple times bigger was the test, which I guess makes sense. I mean, we're talking about a significant period of time that's probably lapsed, and so technology obviously has advanced dramatically since that point. So I don't think it's surprising from a technological point of view, but it is certainly worrying from a devastation point of view, certainly if these missiles do ever, God forbid, get used. So hopefully that puts it into a bit of context, and you can see that the last time, the reason why this is a bit of an escalation is because it's been a bit of a while back since they last did a nuclear test. So we're looking back in towards the back end of last year. As I said then, we've had this kind of classic flight to quality bid, so the flock to havens as defined by this graphic. So this being an elevation for gold prices and the Japanese yen movement as well. This is looking at dollar yen, so obviously movement lower in dollar yen, indicating of yen's strength as we would typically see. Gold, you can see really the last 2 months it's caught a pretty decent bid. This isn't just about North Korea. There's obviously other factors at play here. You've got the debt ceiling. So today is obviously a US holiday. It's Labor Day. So Don't be expecting too much from US participation, because there'll probably be none. So you can expect a fairly quiet afternoon, and we'll see later on in the calendar it is fairly quiet for the US session schedule. But the debt ceiling issue, North Korea, a lot of this then has kind of led to the market underpricing the probability of a December rate hike from the Fed. So all of these types of factors obviously helping assist the move higher in gold prices, and then having busted through $1,300, it's kind of opened up a bit of the upside here. So pretty decent gains overall. Furthermore, we have had further news from this morning. So this is separate now to the nuclear test that occurred at the weekend. South Korea this morning are said to have detected that North Korea is continuing to prepare for a possible intercontinental ballistic missile launch, according to an official. And so, you know, they're not backing down seemingly from just doing the test to see then almost test the water to see how the US in particular will respond. They're following this pretty quickly with further ballistic missile tests. So they continue to be fairly aggressive with their tactic at the moment. Now, one interesting thing that developed, because Trump has responded, and Trump almost responding in a way in which only the US president knows how, and that was via Twitter. I don't know if you saw that at the weekend, but there was a flurry of tweets that came out of the president yesterday, who obviously was directly commenting on the situation. Now, one of the interesting thing here, and that the FT are picking up with their analysis this morning, which I think is quite important here, is that following this sixth nuclear test, caught in the crossfire was an unlikely victim, that being South Korea. So a long-standing US ally rebuked by Mr. Trump for its appeasement of Pyongyang. So basically, to put this in kind of layman's terms, Donald Trump called out South Korea by saying, your time of appeasement has not worked. You should be, we should get more aggressive. And obviously, as the graphic's defining here, this type of almost the divisive talk of Trump against Moon, the South Korean president, is certainly not going to be helpful of the situation. And obviously, South Korean worries and tensions are very high at the moment, given their close proximity, obviously, Seoul to North Korea. So, interesting here. Experts warn that a dangerous divide appears to be opening between Washington and Seoul, a development that, if not halted, could hand Pyongyang and Beijing an easy but significant strategic victory. So again, the South Korean-US alliance goes back a long period of time. The division there really does weaken, I would say, the US stance in that particular geographic region. This is one particular thing, though, that when I woke up this morning, having just reviewed the situation, excuse me, a lot of the commentary that had come out from various politicians, and a look at the charts from last night. This was basically the S&P, and this is the S&P over the missile over Japan that we had in the gap lower. This was last week. You know, you don't have to cast your minds very far back. Then you look at the nuclear test. This is what we've had, the gap lower. Now, the point I was making this morning, I had a tweet pretty early on when I woke up. I just thought, does this really put us any closer towards a military confrontation, or in fact, can the US do anything other than follow a diplomatic path in order to resolve this particular situation? And personally, I think that as much as this is no doubt escalating, I still don't think the market is going to get too spooked by the situation. And so deja vu is a word that I've seen spun quite a lot this morning, and I find it very hard to disagree with that view, that I don't really think that this is going to be the catalyst for some big downside correction in the equity market. I actually think that even though we might see a little bit of a potential for a dip today, I think by the end of the week, given as well we've got the ECB on Thursday, which I'll expect to be, if anything, a neutral to a fairly dovish delivery as they try to kind of delay this tightening process to the end of October or even possibly further in the year, then I think equities personally will come back and this gap will get filled pretty quickly. So despite the kind of gravity of the situation that we're in and all of the points that I've just discussed, you know, just remember what happened last week. We gapped lower only to have a really big, powerful rally thereafter. And then here we are again. It almost feels like a similar type of setup. And if I'm looking at the charts just flicking over this morning, yes, we've gapped lower in the DAX, but you can see despite the initial dip at the futures open, since the cash markets have opened, we've already come back up to the opening price of futures. And so movement higher above here, then obviously you'd be looking to close the gap from the close that we had on Friday. One thing to keep in mind, again, it is a US holiday, so don't be expecting a great deal from the afternoon. You're not going to get that usual pickup in volume when you go into the afternoon session. One quite interesting graphic I quickly wanted to run through with you guys was what is the exact procedure and how long, and from my point of view, when I think about these things, I think, okay, let's say North Korea do something. They fire a missile and it lands on Guam, for example. So we go into a whole new level of situation. How long does it actually take for the president to make a decision? What is that decision route, if you like? And then from him saying yes to a missile getting fired, what is that specific time frame? And so quite an interesting graphic here just to quickly run you through. You might have already seen it this morning, but I think it's just quite a simple way of looking at this in a logical manner. So basically, the president considers a nuclear strike. Obviously in America, Donald Trump has the sole authority, some would say quite worryingly, to use nuclear weapons. So the president makes a decision. What does he do? Pentagon's Deputy Director of Operations. So basically there's a team of staff here that he would then call. They would then discuss the situation and what exactly it is that they'd want to do. Let me just flip my screens over. Thank you, Philippe. So the president here calls then his Director of Operations. They discuss this. And actually the discussion that takes place would typically last less than a minute. So again, this does make it slightly worrying that actually the president holds an awful lot of power in this decision-making process. And there's not a lot of time for debate in this particular situation. The type timeline then does raise the risk of launching hastily on a false warning. You know, I did read a good article that talked about kind of a black swan event, doomsday scenario, and actually in this world of technology and hacking, a miscommunication or I guess a false alert, how quickly this chain of events could occur for a retaliation strike to happen. And then obviously this is when you go into World War situation. But then, okay, after this, following the conversation that takes place, the president decides to launch. The Pentagon must comply with the Commander-in-Chief's order. The order is then verified, i.e. basically there's a military aide that's always with the president who carries a letter with a challenge code on it that they then authenticate in order to make sure this is the president, to obviously circumvent hacking and so forth. The order then goes out. There's a 150 character code that then gets initiated. And at this point, don't forget, there's only 2 to 3 minutes that have elapsed in actual time. The launch crews then take over. If the missiles are from a submarine, it then gets launch code provides the combination to an onboard safe holding the fire control. Missiles are ready for launch about 15 minutes after receiving the order. If it's a submarine, that time frame is shortened considerably, I believe, if it's done from land. Mutiny is likely, but it takes just 2 votes to launch the missiles. So even if 3 2-officer ICBM as intercontinental ballistic missile crews refuse to carry out the order, it basically can't stop the launch. The missiles are launched. Approximately about 5 minutes may have lapsed from the president's decision before intercontinental ballistic missiles have left their silos. So hopefully that puts it into a bit of context. It takes about 5 minutes for then the president to give the order for the missiles to leave their canisters, so to speak. Submarines slightly longer, about 15 minutes. All of this, though, a lot of people talking about this is about as much tension as the nuclear situation going back to the kind of Cuban crisis, and it's hard to disagree with that. But again, as I've just discussed, irrespective of this, is that same chart where actually I would say, despite maybe momentary concern, I actually think the market will move on fairly quickly. That doesn't mean that I'm not, of course, monitoring Trump. He is a fairly volatile character in terms of the type of communication, the rhetoric that he uses, and also importantly, I'd be interested to see what China has to say as the days go on. But what you must understand is that China have a very big yearly meeting. Basically, this is what they call their Politburo, which is all of their main movers and shakers, from central bankers to military to the president. They all come together for one meeting, and that's not happening until later on in a few weeks' time, about 6 weeks. I think it's the middle of October. So before then, I'm not expecting actually anything other than just towing the line of diplomacy from China. As such, then, don't see much reason to not think that this equity market won't close this gap at some point and continue to probably edge higher. Okay, so that's the Korean situation. Moving on then, there's a couple of headlines else that I want to cover, and hopefully I can wrap through this pretty quickly. One is Russia. Russia likely to back extension of OPEC deal as prices stabilize. Preliminary assessments suggest output cuts stabilize the market. OPEC agreed to a 9-month output cut extension, of course, from last May. Now, this chap here, Djokovic, is not an oil minister. He is a politician, but a fairly senior one. And so his, I guess, weight behind such commentary, I'd say, is lesser extent than it would be an oil minister, which is Novak when it comes to Russia. And we are still 6 weeks or 6 months away. And so I think it's a bit much to talk about likely outcome as a deal extension when we're 6 months away from that deal having to be made. But nonetheless, certainly this is what the Russians are saying. And as we know, they're, of course, an extremely influential member in making sure these cuts go through. So still a little bit of verbal management of crude oil prices going on by the Russians at the moment. Elsewhere, you might have read about this. There was a one and only televised debate at the weekend. Angela Merkel's election opponent, Martin Schulz, failed to score a decisive breakthrough in this televised debate. Schulz was picking on Merkel a lot about the issue of immigration. That's what he's kind of, this whole campaign's been geared upon, is calling out Merkel on this German rise of terrorism because of her view of having an open border, but she stands resolute that that is the right decision, and obviously her being one of the main staples of the Euro ideology. So they had the televised debate. There was 2 exit polls that came out. One had them even Steven, the other one had them Merkel win. What does this mean? Well, I think what this chap's written here, Merkel win is a sure bet. I can assure you nothing is sure in life, and so as much as Merkel is 96% on, pretty much, to win the German election, which of course is coming at the end of the month, there's always, of course, a tail risk that it doesn't occur, but I believe that the current gap in polling is about 13 percentage points. Don't forget, Scholz and Merkel were even only a few months ago, but Merkel's made a pretty strong pull away since May, really, and they've divided quite substantially to make most people fairly comfortable with the view that there really shouldn't be much risk to Merkel and her position as Chancellor. The other thing I read from the weekend that came out of the Sunday Times, and you've already had the Brexit minister on the UK side talking the other side of the book, So let me talk about the Sunday Times firstly. They reported that Theresa May would offer to pay between 7 to 17 billion a year to Brussels for 3 years after Brexit, totaling then that Britain are offering to pay 50 billion pounds as a divorce bill to the EU in order to begin trade talks in October. And this to me sounds completely plausible, given the fact that, you remember, the range is about 25, 75. We started at 1 to 100 and we've come all the way together. And so I think this is pretty much to be expected. This is said, this 50 billion, according to the Times, to be on the down low, so to speak, i.e. there's the October Conservative Party conference that gets held every year. It's happening between the 1st and 4th of October. Theresa May will probably want to keep this 50 billion discussion in the background because she'll want to remain quite strong about following this current trajectory of negotiating for a better deal for Britain and hard Brexit and so forth. And so now's not the time to be bringing forward a fairly substantial size of money that's only going to annoy the more kind of hard Brexit Conservative members. So these talks seem to be ongoing, and as I've always said, I think this is completely inevitable. I stand by it quite strongly that at some point in time Britain will need to cough up a substantially large amount of money in order to secure that transactional deal. The only time is between now and then, I would say, would create a negative backdrop for sterling. But as soon as that deal is done and we have clarity for then discussing the trade talks for Britain over the next 3 to 5 years, I would expect the pound to recover thereafter. David Davis then, the point being here, has come out and rejected that report as nonsense. So that's the latest on that. The final point that I wanted to cover here was we had non-farm payrolls. Let's not forget, non-farm payrolls, I think I remember tweeting at the time, it will be forgotten about by Monday. And lo and behold, here we are, Monday's come. Who remembers non-farm payrolls? Well, no one, because no one cares. So after about an hour or two of highly volatile price action, and actually it did, it was quite a tradable event in many ways, because we had a headline that was 156,000. It was expected at 180. Unemployment ticked up to 4.4 from 4.3%. You had a downward revision to the previous, a negative 2 month net revision of about 40,000. The wage data as well on the year-on-year was a 0.1 miss at 2.5 year-on-year. So overall, there was a clean sweep of negatives. But let's not forget that 156,000 is still a fairly healthy number of jobs, and the wage data at a 0.1 miss but up 2.5% year-on-year, still within, I feel, the remit of the Fed feeling not, I would say, completely comfortable, but not having to change their idea about what it is that they're going to need to do to execute their plan for the end of the year. So if you look at federal funds rate futures, this is what the market is pricing in the short end of the curve, 42.1% probability that the Fed will hike rates in December. What was this before non-farm payrolls and earlier last week? 42%. So despite this having variation of about 10% over Friday's session in the aftermath of payrolls, net-net, the market has not dwelled on that fact. The other thing here that I think is important about the US and also the Fed's ability to tighten policy going forward is the debt ceiling. Now, US politicians on Capitol Hill have been on recess through the whole entire summer period. But after Labor Day, which is today, they then come back to work. And the first pressing thing on the agenda is resolving the debt issue, which otherwise means that the government, the US corporation, if you like, would go into default, technically, next month, if they don't get a resolution to this issue. Now, one thing interesting that occurred at the weekend was Steven Mnuchin noted that the debt limit should be linked to a package of relief for victims of Tropical Storm Harvey. And so, for me, that Mnuchin comment has drastically dropped then the risk around a debt ceiling situation, because there is absolutely no doubt in my mind that politicians will want to pass a short-term spending bill for the area that was devastated by the Hurricane Harvey. They have to do that. There is no political edge or leverage that you could get with not helping the Texas Houston area. You know, they've had a cataclysmic natural disaster. They require funding for infrastructure building and fixing that area, essentially. And so tying that now to the overall government's debt ceiling, well, then most politicians are going to feel compelled to have to vote for that. And so now I think that the risk of the debt ceiling being a real issue and politicians kind of using it as an excuse to leverage their own agendas, I think has diminished substantially. And if anything, then I think that that makes, again, equity markets feel a little bit more comfortable at these highly valued levels, and it makes fixed income markets want to price the fact that, well, actually, if that risk goes away, then yes, we're still monitoring the inflation issue in the US, but overall, the Fed still remain at this point on track. So, a couple of interesting comments there from Munchen at the weekend. Okay, let's wrap it up with a look ahead to the calendar for today and tomorrow. As you can see here, today on a calendar perspective is extremely quiet because of the Labor Day holiday in the States. One thing I'd be mindful of is, if we break the kind of opening prices in some of the instruments from the initial gap moves, so i.e. in equities and in fixed income, just be mindful of any closing of the gap in a reversal of the flight to quality move overnight. But obviously monitoring for commentary on the situation as it develops. Looking at the week as a whole, though, that's probably more interesting because there are a couple of key events. This is the calendar that Philippe did at the weekend, and I sent it out to you in your email this morning. So Tuesday, overnight, for anyone trading the Aussie currency, you've got the RBA interest rate decision. So that's coming basically this evening. UK services PMI on Tuesday. Let me transition my screen so you can see this. So UK service PMI on Tuesday, that's always a really crucial number, given we're such a dependent on that from a GDP perspective. It's the bulk of our economic output coming from that particular sector. So that's always influential for the pound, and in the context of this overall kind of cloud of uncertainty on Brexit, be interested to see how the service sector has been holding up. Then you've got some speakers, Fed, quite heavy, Brainard, Kashkari, Kaplan. Wednesday, you then move on. You've got the Canadian interest rate decision. You've got your regular API crude oil inventories. Remember, if you're trading the crude inventory data, everything's going to be pushed back one day this week because of the bank holiday in the US today. So APIs will be Wednesday evening. Department of Energy inventories will be on Thursday afternoon. Then on Thursday is kind of the main event, if you like. You've got the ECB interest rate decision and then the press conference with Mario Draghi. But do not forget the source comments that we had on Friday shortly after non-farm payrolls. Let me just refresh your memory. You remember euro dollar? It was like the Wild West on Friday. You had an initial spike higher. That was the dollar dumped on the back of the clean sweep of bad data coming out of non-farm payrolls, only then for several minutes after, Bloomberg ECB sources, almost perfectly timed if you were being a bit of a conspiracist theory of the ECB not wanting a too firm a currency, because Bloomberg sources came out and said, against market consensus, that, you know what, given the complexity of the tapering decision, it's not going to be ready for the end of October meeting. It's going to be more like December when we actually start to unveil more details in this tapering process. So the euro then dived lower after that reading. So not really looking for a great deal from the ECB in this September meeting. As I say, October is the one that's really more interesting at this present point in time. But nonetheless, always a market mover. Then on Friday, you've got UK manufacturing, industrial production, balance of trade, some German data, the equivalent as well, trade data, and that pretty much wraps up the week. So today's probably going to be the most quiet in terms of market volume, and potentially then translating to market action, and then things will start to return to normality as the week goes on. One other just final point that I failed to mention with non-farm payrolls that I wanted to make you aware of, and that also kind of further cements this argument about non-farm payrolls being largely brushed aside, was that a good stat from Deutsche Bank this morning. They've said that statistically, since 2010, August non-farm payrolls have been revised up by 55,000 on an average basis between the initial and third prints. So just given the seasonal factor for the holiday adjustments, given it's the month of August, actually the first reading that we see, i.e. the one that we had on Friday, tends to get revised higher by an average of 55,000. Hence the markets are fairly comfortable with what occurred on Friday. Okay guys, that's it. It's your morning briefing, so have a good day. And any questions, of course, just let me know. I'll be in the chat room. Thank you.